The closing bell rang exactly 15 minutes ago. And if you were just looking at the top line scoreboard for this Thursday, July 2nd, 2026 session, you are completely missing the real story.
Oh, absolutely. The surface numbers are a total mirage today.
Right. Because the S&P 500 closed functionally flat, it moved a microscopic zero point zero 0.01 points to settle at 7,483.24. But underneath that supposedly calm surface, the tech-heavy Nasdaq Composite shed 0.80%, giving up 207.36 points to drop to 25,832.67.
And then you look at the Dow.
Exactly. The Dow Jones Industrial Average just ripped higher by 1.14%, adding 594.83 points to hit a fresh all-time record close at 52,900.07.
Which tells you exactly what kind of market we're actually in. I mean, this wasn't a head fake, and it certainly wasn't just pre-holiday chop. We just witnessed a violently aggressive structural rotation.
A massive wealth transfer right before the long Independence Day weekend.
Yeah, the real money didn't just pack up early. They actively executed a coordinated pivot out of speculative growth and dumped that capital straight into defensive value into the close.
And we've got the closing print briefs and, the raw options data right here to decode exactly how that rotation happened. So let's start with the macro catalyst that actually lit the fuse this morning. The June non-farm payrolls report hit the tape, and it was an absolute shock to the system.
A total miss. I mean, Wall Street models were projecting a standard, manageable cooling, right? Somewhere in the 110,000 to 115,000 jobs range.
But the actual print came in at a freezing 57,000 jobs.
And you can't just look at June because the institutional algorithms instantly digested the revisions. We saw downward revisions to April and May totaling 74,000 jobs. So the entire quarter's labor foundation is substantially weaker than the market previously priced in.
Right, so let's walk through the mechanics of that reaction. A freezing jobs print means the U.S. economy is actively slowing down. So the immediate market response is this sharp drop in Treasury yields because any lingering threat of the Federal Reserve hiking interest rates in the near term is, well, it's completely dead now.
Yeah, you simply cannot tighten into a labor market that's only printing 57,000 jobs.
But the real risk here is the growth panic, right? Historically, when growth fears suddenly spike like this, we see capital completely flee the equity markets and just hide in cash. A rising fear of recession usually triggers blanket liquidation. So why didn't that happen today?
Because the institutional money didn't view this as a systemic collapse. They viewed it as a mandate to reallocate. The narrative shifted instantly. The risk of the Fed keeping rates too high for too long just evaporated.
But something else filled that vacuum.
Exactly. A much more specific anxiety took its place, which is AI capital expenditure fatigue. The big money basically used the weak labor data as top cover to dump their most overextended, high-multiple semiconductor and hardware positions.
And the trigger for that specific AI fatigue narrative actually came from Meta. We saw reports cross the terminal today indicating that Meta is planning to sell off some of his excess AI compute capacity.
Which is a massive signal.
Right. I mean, on the surface, a company optimizing its server farm doesn't sound like a market-breaking event. But you have to look at the underlying thesis that has driven the Nasdaq for the last 18 months. The entire semiconductor rally has been built on this premise of infinite, unquenchable demand.
The perceived arms race.
Yeah, these major tech companies spending billions on hardware without even looking at the price tag.
And that is the core of the issue here. Tech hardware trades on the second derivative of demand. It isn't just about whether demand is high, it is about whether the growth of that demand is actually accelerating.
And Meta just signaled it's decelerating.
Precisely. When one of the largest buyers of compute power in the world signals they have excess capacity, it shatters that illusion of infinite acceleration. It introduces the concept of diminishing returns to the market.
And the multiple compression we saw today was just brutal. I mean, when the growth assumptions shrink, the forward earnings estimates collapse and the stock price corrects violently. Just look at the carnage in the semiconductor space.
It was a bloodbath.
SanDisk plummeted 11% today. That is a 23% drop in just 48 hours following these CapEx warnings. KLA Core trying to hold the green at the open but reversed hard, closing down 8.21%. Marvell dropped 8%.
And Micron.
Yeah, Micron slid over 4%, breaking right down through that critical psychological floor at $1,000.
The bid-ask spreads on those names widened significantly, and the algorithms just relentlessly hammered the bid. But the critical piece of the puzzle is tracking the capital flight. When an institutional desk unwinds a massive semiconductor position, that cash doesn't just sit in a vacuum.
It has to go somewhere.
Right. It rotated directly into sectors that offer defensive, recession-resistant cash flows.
Okay.
Healthcare actually led the market today, finishing up 2.70%.
And Amgen was a major driver there, surging 3.01% after a federal judge blocked a state-level 70% price cap on Enbrel, which obviously protects a massive revenue stream for them. Moderna jumped 6.46% on heavy defensive volume, too.
Which is classic defensive position.
But here is the disconnect I am really trying to wrap my head around. If we are seeing bellwether semiconductor stocks dropping 8 to 11%, and the NASDAQ is bleeding out over 200 points, the overall market should feel incredibly heavy. Yet, the closing print brief shows incredible breadth today. Over 66% of the stocks within the S&P 500 finished the day in the green.
It's phenomenal divergence, honestly.
Yeah.
We are basically looking at a reverse breadth signal.
How so?
Well, for over a year, analysts have complained about the magnificent few tech stocks artificially inflating the index, while the average company just struggled to stay flat. Today, the exact inverse happened. The mega-cap tech titans acted as a massive anchor, dragging the index down, but the buying pressure in the other 490 stocks was so aggressive that it completely offset the tech drag.
Pinning the S&P 500 flat at 7,483.
Exactly. But you have to factor in the liquidity environment because the volume profile today actively amplified that kind of price action.
Right, because tomorrow is Friday, July 3rd, and U.S. markets are closed for the holiday weekend. The institutional sources explicitly refer to today as a holiday tape.
And a holiday tape means the major desks packed up at noon.
Yep. So when order books are that thin and the liquidity just dries up, any localized buying or selling pressure moves the market significantly more than it would on a normal Tuesday.
The thin order book absolutely exaggerates the intraday swings. But, even accounting for the holiday tape, the options market is telling us a very clear story about how the real money is interpreting this rotation. And that brings us to the VIX.
This is the real mystery of the day. The VIX, which, everybody refers to as Wall Street's fear gauge, actually dropped 1.87% today to settle at $16.28.
Which makes no sense if you just look at the headlines.
Right. We have a freezing labor report. We have the NASDAQ selling off. Overnight in Asia, South Korea's Kospi index, which is heavily exposed to global semiconductor demand, plunged a massive 7.9%. You would expect the market to be terrified. The VIX should be spiking toward 25. How does the fear gauge drop during a tech flush?
Because treating the VIX purely as an emotional thermometer is a fundamental misunderstanding of market mechanics. The VIX is a mathematical derivative. It calculates implied volatility based on the premium traders are willing to pay for S&P 500 put options.
Meaning it measures how much capital is being spent on broad portfolio insurance?
Precisely.
So if the VIX is dropping, it means portfolio managers are actively deciding not to buy insurance on the broader market.
Exactly. They're watching the semiconductor space collapse, yes, but they're also watching 66% of the S&P 500 components catching a bid.
Yeah.
They realize this isn't a systemic liquidity crisis.
It's an orderly sector rotation.
Right. Institutions are definitely buying protective puts on their individual mega-cap tech holdings, but they are simultaneously unwinding their broad index-level hedges. The lack of demand for broad index insurance absolutely crushes the implied volatility, driving the VIX down to 16.28.
That structural resilience is fascinating. It proves the market's foundation is actually expanding, not cracking. And you can even see that nuance within the tech sector itself. The hardware players were decimated, but the software companies actually staged a clean upward reversal today. Palantir jumped 3.49%, and Adobe gained 3.90%.
Which confirms the market is surgically pricing in the Meta-CapEx news. Software margins don't require the same relentless multi-billion-dollar hardware infrastructure spend once the primary models are actually deployed.
Capital is fleeing the picks and shovels trade and looking for the companies that have already built the mine.
Perfectly said.
And speaking of companies building out their ecosystem, we have to look at the massive divergence between two of the most popular retail stocks on the board today, Apple and Tesla. Let's start with Apple. In the middle of this hardware bloodbath where memory and NAND component prices are actively rising and threatening profit margins, Apple completely defied gravity.
It really did.
The stock ripped 3.8% to close at $305.61. And the data shows this wasn't retail speculation on thin volume. This was sustained institutional accumulation.
Because the market is treating Apple as the exception to the hardware rule. They don't view it as a traditional hardware manufacturer anymore. The institutional thesis views Apple as the ultimate consumer AI distribution platform.
Yeah, but wait, if global memory costs are skyrocketing due to supply constraints, Apple still has to physically buy those chips to put in the new iPhones. Doesn't that actively compress their margins? Is the institutional money just blindly ignoring the cost side of the equation?
They aren't ignoring the costs. They're calculating the offset. The institutional bet is that the margin hit from memory components will be completely eclipsed by a massive consumer upgrade supercycle.
Because everyone wants the new AI features.
Exactly. The market believes consumers will replace their phones significantly faster than usual just to access Apple's new localized AI roadmap. And for active traders plotting a day two play for Monday, the setup is highly defined here.
What's the level?
A break above Thursday's high of 305.61 serves as a trigger to go long, targeting the 312 zone, utilizing a tight structural stop loss just beneath the $300 psychological floor.
Okay, now compare that aggressive accumulation in Apple to the absolute bloodbath we saw in Tesla. This is where market mechanics get incredibly counterintuitive for you if you're just trading the headlines. Tesla delivered what, on the surface, looks like a blowout quarter.
Massive beat.
Right. They reported 480,126 vehicles sold in Q2. Wall Street was modeling for roughly 406,000, or that is an undisputed massive delivery beat. And yet, the stock crashed. It plunged 7.5% on heavy volume to close near $395.
This is a textbook execution of institutional exit liquidity. It is the purest form of a sell the news event.
Let's break down the actual mechanics of that. When we say sell the news, what is actually happening in the order book between the institutional desk and the retail trader?
Well, let's say you run an institutional desk and you are holding a massive block of Tesla stock, millions of shares. Your internal models indicate that the underlying business fundamentals are deteriorating and you want to exit the position.
But you can't just dump millions of shares onto the open market on a random Tuesday.
Exactly, because your own selling pressure would collapse the bid and you'd destroy your own execution price. You would crash the stock before you could even get out.
Right.
So you need a liquidity event. You need a massive, concentrated tsunami of buy orders to absorb your sell orders. When Tesla announces a headline beat of 480,000 vehicles, the financial media blasts the number everywhere.
Retail traders see the headline, experience immediate fear of missing out, and just flood the market with market buy orders.
And the institutional algorithms use that localized spike in retail demand as the exact liquidity they need to distribute their massive positions without instantly tanking the price. They use the retail buying frenzy as a cushion to safely exit the burning building.
But why were the institutions so desperate to get out in the first place? If Tesla is selling 480,000 cars, isn't the underlying business actually booming?
The smart money looks past the top-line revenue and focuses entirely on the cost of that revenue. To achieve 480,000 deliveries in a high-interest rate environment, Tesla had to aggressively slash prices and offer massive financing incentives.
Which kills the margins.
Exactly. The institutions are running the math on the margin compression, selling more cars at substantially lower margins, while simultaneously bleeding North American market share to legacy automakers. That is a fundamentally bearish dynamic.
It's the difference between volume and profitability. And the technical damage on the chart is severe. The trading playbook for Monday highlights that if Tesla breaks below Thursday's low of $395, it triggers a cascade of short-selling momentum, targeting a slide down to the next key support zone at 380.
And if you are playing the short side there, the brief suggests a hard stop at 405 in case of a mechanical snapback rally.
The contrast really is stark. You have the exact same macro environment, but Apple sees aggressive institutional accumulation based on forward-looking software margins, while Tesla suffers brutal distribution due to backward-looking hardware margin compression.
It really highlights why you have to look under the hood.
So looking ahead to the open on Monday, July 6th, we need to look at the S&P 500 options data, because the structural levels dictate the boundaries of the playing field. The S&P closed at 7,483. The institutional gamma pin data highlights a massive gamma wall sitting overhead at 7,500 and a critical gamma flip point sitting below us at 7,455.
We need to understand how dealer positioning creates these boundaries. When retail and institutional traders buy millions of options contracts, the market makers, the institutional dealers on the other side of those trades, take on massive directional risk.
Right, and to keep their own books perfectly neutral, these dealers have to dynamically buy and sell the underlying S&P 500 futures as the market moves.
Which is delta hedging.
Right.
If I'm a market maker and I sell you a call option, I am essentially short the market. As the market rises, I start losing money on that contract. So to hedge my risk, I have to actually buy the underlying index as the price goes up.
And that hedging activity is dictated by the gamma profile. As long as the S&P 500 stays above that 7,455 level, the dealer positioning is net long gamma.
And under these conditions, the dealers act as a stabilizing force in the market.
They basically act like giant shock absorbers.
Precisely. When the market dips down towards 7,455, the dealers are mechanically forced to buy S&P futures to stay neutral. That buying pressure creates a floor.
And when the market rallies up toward the 7,500 gamma wall, where that massive cluster of call options resides, they are forced to sell futures, which creates a ceiling.
They essentially trap the market in a tight, bouncy range.
Right, and because of that structural shock absorber and factoring in the notoriously thin volume of a post-holiday Monday, the quantitative models are actually assigning a 65% probability of range-bound consolidation. Meaning, if nothing breaks the system, we just bounce harmlessly between 7,455 and 7,500 all day Monday.
But
what happens if the floor gives out? What if a headline hits and we drop below 7,455?
the shock absorbers vanish instantly. If a market breaches 7,455, the dealer positioning flips from net long gamma to short gamma. And when dealers are short gamma, their hedging requirements reverse.
Meaning they are forced to sell when the market drops and buy when the market rises.
Yes, their hedging actively accelerates the momentum. It creates a trapdoor.
A total cascade.
Exactly. If 7,455 breaks, the market loses its volatility cushion. The selling pressure will compound on itself, and the index could drop very quickly through the 20-day moving average at 7,445, straight down to the 50-day moving average support level at 7,400.
So the active trader playbook notes that shorting a confirmed breach of 7,455 is the highest reward asymmetric trade setup for Monday. And the primary catalyst that has the potential to trigger that trapdoor or send us rocketing back toward the 7,500 ceiling lands first thing Monday morning.
The ISM Services PMI data.
Exactly. The ISM Services PMI will hit the tape. Every institutional desk is going to be watching that number to see if the severe economic cooling we witnessed in today's 57,000 jobs print is isolated to specific manufacturing sectors, or if it is aggressively bleeding into the broader services economy.
It is the ultimate litmus test for the soft landing narrative. I mean, the market is currently pricing in a slowdown that justifies rate cuts, but avoids a recession.
Right.
But if the ISM Services data comes in significantly lower than expected, that narrative cracks, growth panic sets in, and that 7,455 gamma floor will be severely tested.
So the bottom line for you listening, delete the headline S&P 500 number from your mind. That zero point 0.01 point flat line is a complete illusion. The market is executing a tectonic shift. Capital is aggressively bleeding out of the overcrowded, overextended semiconductor trade, driven by undeniable fears of diminishing returns on AI capital expenditures.
And that capital is rapidly finding a new home in defensive, high-quality, cash-flowing blue-chip stocks.
Which really leaves us with a critical strategic question for the remainder of the year. For 24 months, the entire equity market's performance has been entirely dependent on a handful of Silicon Valley tech titans driving the artificial intelligence narrative.
Everyone has been waiting for the market breadth to finally expand.
Right, waiting for the generals to rest so the soldiers can catch up.
But if the U.S. economy actually manages to thread the needle, if we achieve a soft landing without tipping into a deep recession and the Federal Reserve begins a gentle rate cut cycle, we really have to evaluate the new market leadership.
Because it might not be tech.
Exactly.
Yeah.
Could the next major sustained leg of this bull run be completely devoid of AI hype? Are we entering a phase where the boring, reliable, dividend-paying companies of the Dow Jones Industrial Average, the companies we've basically ignored for 2 years, finally take the wheel and drive the indices higher?
It requires a complete reset of the trader's mindset. You cannot just buy the tech dip blindly anymore. You have to respect a rotation, watch the volume confirmation on Monday, and keep your eyes locked on that 7,455 gamma flip point. The surface of the market might look calm, but the currents underneath are moving incredibly fast. We will see you for the opening bell on Monday. Have a great Independence Day weekend.